Let's say someone hands you $10,000 today and says, you can either put this into VOO or try to pick winning stocks, but you've got to stick with it until 2040. What would you do? Seriously, would you go with the safer, slow and steady option? Or would you take a shot at hitting it big? Now, if you're wondering, wait, what's VOO? It's basically a bundle of the top 500 companies in the US. It's like buying a little piece of Apple, Google, Amazon, and a bunch of others all at once. In this video, we're going to break it down. What's smarter in the long run, VOO or picking stocks yourself? We'll look at the pros, the cons, and what might actually make you richer by 2040. Let's get into it. Alright, so let's talk about VOO for a second. VOO is short for the Vanguard S&P 500 ETF. I know, sounds a bit fancy, but it's really simple. Imagine you could own a tiny slice of 500 of America's biggest companies. Apple, Microsoft, Coca-Cola, Nike, and so on. That's basically what VOO gives you. It's like a team made up of the top performing companies, all working for your money. The cool part? You don't have to choose the companies yourself. You just buy VOO, and boom, you're instantly investing in a big mix of solid businesses. It's super popular because it's low cost, easy to manage, and historically, it's grown pretty well over time. So yeah, VOO is like the set it and forget it option for long-term investing. Now let's flip it. What if you don't go with VOO? What if you decide to pick your own stocks? Stock picking means you're choosing individual companies to invest in. Maybe you love Tesla, think Nvidia is the future, or believe some small startup is about to blow up. You're calling the shots. You research companies, look at trends, maybe even watch a bunch of YouTube videos to figure out what's hot. And sure, if you choose right, you could make a lot more money than someone who just sticks with VOO. Like, imagine investing in Amazon or Apple back in the early 2000s. Life-changing. But here's the flip side, you could also pick losers. Not every company ends up like Amazon. Some go up, some crash hard. And let's be real, timing the market is tough. Even pros get it wrong. So, stock picking? Big potential, big risk. Alright, let's put these two head to head. White heavy checkmark VOO. The pros. First up, VOO. Why do so many people love it? Well, for starters, it's simple. You don't need to be a stock market genius. You buy it, hold it, and let time do the work. It's also super diversified. You're not betting on just one company. You're spreading your risk across 500. So if one crashes, the others help balance it out. And historically, VOO has returned around 8 to 10% a year. That's pretty solid for just chilling. Cross-mark VOO, the cons. Now here's the downside. You'll never beat the market. Because, well, you are the market. If you're hoping for a 10x or 20x return like early Tesla investors got. Yeah, VOO's not doing that. White heavy checkmark stock picking, the pros. Now let's talk stock picking. The upside? If you pick a winner, you could crush the market. Imagine you had bought Netflix when it was still mailing DVDs. Or Nvidia before AI took off. That's the dream, right? Plus, stock picking feels a little more exciting. It's hands-on. You feel in control. Cross-mark stock picking, the cons. But here's the truth. Most people don't beat the market. In fact, a lot actually underperform. Why? Emotions. FOMO. Panic selling. Chasing hype. It's easy to get caught up in the noise. And without proper research and patience, stock picking can burn you. Alright, let's fast forward. It's the year 2040. You've been investing consistently since today. So, what could your money look like by then? Let's say you start with $10,000. If you put that into VOO and it grows at, say, 8% a year, pretty average historically, you could be sitting on around $50,000 to $70,000 by 2040. And that's without doing anything. No stress, no drama. Now, what if you picked the right individual stocks instead? Well, your $10,000 could turn into $100,000, $200,000, maybe even more. But here's the catch, what if you picked the wrong ones? That same $10,000 might shrink. You could end up with less than what you started with. Some stocks just flop. Companies go bankrupt. Markets change. So yeah, stock picking could make you way richer or cost you big. With VOO, you're probably not going to get rich overnight. But you're also not likely to lose sleep either. So, which one's better for you? Let's break it down. If you're the kind of person who wants to invest without overthinking it, you're not glued to financial news, you don't enjoy picking stocks, and you just want to grow your money quietly over time, VOO is your best friend. Set it, forget it, and check back every few years. But if you're someone who loves digging into company earnings, following trends, taking calculated risks, and maybe even enjoys a little adrenaline, then stock picking could be your thing. That said, here's a pro tip a lot of seasoned investors follow. Do both. Put most of your money in something safe like VOO, and then set aside a small chunk to play around with individual stocks. That way, you've got a solid foundation and still get to chase the big wins if that's your style. So, what's the final verdict? VOO gives you long-term growth, peace of mind, and way less stress. Stock picking is a wild ride with higher highs but way riskier lows. At the end of the day, it comes down to you, your goals, your risk tolerance, your time. So, let me ask again, by 2040, which path will get you closer to the life you want? Let me know in the comments, are you riding with VOO, rolling the dice with stocks, or doing both? If this helped you think about investing differently, hit that like button, share it with someone planning their financial future, and don't forget to subscribe for more simple money tips. See you in the next one.